What do you see when you look at this photo? You probably see a normal Dubai apartment tower, right? But I see 3 red flags that can destroy your real estate profits. Avoiding bad deals matters just as much as finding good ones. So in today's video I'll walk you through 9 red flags to watch out for before investing in Dubai real estate. Starting with red flag number 1. Location that's not growing. You think it's easy to notice? Think again. Let me show you something. This graph illustrates the average price per square foot in Motor City. It looks like nothing has been happening in the area for years. And then in 2024, it exploded. According to this data, the 3-year growth is more than 100%. And most of that growth happened in 1 year. Agents and social media were claiming that Motor City is the fastest growing area in Dubai. Let's break this down and figure out what's wrong with this data and how to reveal the true growth. The graph I just showed you suggests that if you bought something in Motor City for $250,000 3 years ago, it would now be valued at more than $500,000. But let's remove the off-plan properties from the graph. Now it shows the price growth of just ready properties. And it looks much more stable. The year-over-year growth in 2024 was 17%, and the 3-year increase is around 29%. And that's the same as the market. What the first graph didn't show you is that higher-priced developers entered the area with their off-plan projects. That confused the data, of course. The quick and dirty way to reveal the real growth of the area is just checking secondary market dynamics. This approach isn't perfect, because the delivery of new higher-priced units will also affect it. So the most accurate approach is to assess the price change of separate buildings. However, the past performance isn't always a good predictor of future performance. Right? Let's take Maritime City as an example. Over the last 2 years, growth was only 46% per year. That looks weak by Dubai standards. But there's an obvious reason for this. There is nothing there. The neighborhood is just one building and port. But in a few years, it will change completely. Beyond Select Group, Damek, Live and others are actively building there. Beyond is building a community with parks, a school, potentially a private beach, and more than 8,500 units. So in cases like this, past data is irrelevant. It's about what's coming next. But even if you invest in a rapidly growing area, you can still leave a lot of money on the table if you go with the wrong developer. So let's do a quick rundown of the signs you'd better watch out for. Red flag number 2. A history of big delays. If there is one big thing to avoid in real estate, it's buying from a developer that has a past of massive delays. Because delays have a huge impact on your investment case. That said, all big developers occasionally face delays. This isn't a red flag by itself. The red flag is frequent and long delays. So to find out their delay history, you just need to do a quick Google search. And there are 2 things to look out for. First, their original completion date. A project that takes 9 years to be built, like the Apos by Amniyat, might sound delayed, but in this case, investors knew from the start that it would take this long. Second, some developers finish projects started by others. It might look like the developer was missing deadlines, but in reality, they were being missed by a different company. Pentaminimum in Dubai Marina is a good example. It began in 2008, stopped after 3 years, and later Select Group took over. From the outside, it looks like a 15-year delay. But Select Group only started in 2023. Delays often go hand in hand with another huge red flag. Red flag number 3. Bad performance compared to the market. To explain it, let's take a look at this amazing apartment in Dubai. It has very expensive furniture, with views of the sea and the Burj Khalifa. It looks too good to be true, right? And it is, because this render was made using ChatGPT. It's not a real apartment. But of course, it looks so perfect many probably want to buy it. But it's important to remember that the ability to make glossy brochures has zero correlation with real performance. If a developer typically performs worse than the market, it's a big red flag. It's very unlikely that they'll suddenly build a dream project that outperforms the rest of Dubai. The right move is to check the data, but data can trick you. Here is an example. This developer has a building on Palm Jumeirah. From 2020, the average price growth was 24%, which is not awful. But if I add another line showing you the average growth of ready properties on the Palm, things change. That 24% growth looks a lot weaker, and here are the results for that developer's other projects, which are not good at all. So, finding the right market for comparison is critical. And if the developer is building on the Palm, you'd better compare their performance with the average results of the Palm. If there is not enough good evidence, I wouldn't recommend investing. But if you need help with making a good investment, get in touch with us. If you're new to this channel, I run a real estate advisory and brokerage in Dubai. We help affluent and high net worth individuals invest here. For all of our clients, we basically do 4 things. First, we create a shortlist of properties that match your budget and goals. Second, we prioritize it with you, using data and on-the-ground experience. Third, we secure the strongest available unit. And finally, we rent it out or resell it for you. Just scan the QR code, click the link below, or message us on WhatsApp to book a free consultation. But there are cases when you have just nothing to compare with. Red flag number 4. No history. If a developer hasn't built anything in Dubai before, how do you know if you should work with them? Well, if there is no evidence that they've done a good job, I wouldn't recommend investing. But some developers might be new and great. Yet not many people know about them, so the prices are low, and there is a system to find these hidden gems. First, look at their projects in other markets. There is no point in assessing something under construction, you need something ready. So if they have completed projects in England, Spain, India or somewhere else, that's a good data to consider, but don't take everything at face value. Check that the overseas projects are actually real, and if they got decent reviews. Second, check their contractors. Some developers are actually former contractors themselves, so you can review the quality of what they deliver. But keep in mind that contractor is quite a broad term. They could be technically called a contractor if they were delivering pizza to the construction site. So make sure they did a significant amount of work on the project. Third, review the top management's background. There are rare cases when the brand new developers team consists of top players from top Dubai developers. By the way, there is one more red flag that is super easy to notice, because developers themselves are openly sharing it and even promoting it. Red flag number 5. Guaranteed returns with no substance. The phrase guaranteed returns can mean one of two things. The first is the buyback plan. This means the developer promises to buy the property back from you after 8 to 10 years, often at the original price or higher. But this can be a trap. The buyback promise might be mentioned in the brochure, but its true meaning isn't fully clear until you read the sales and purchase agreement. And if you see phrases like subject to market conditions or buyback optional, that means developers can change the terms of buyback at any point. Guaranteed returns can also mean that the developer promises you'll make around an 8 to 10% net yield from rent. This might sound amazing, but let's see what investors typically get from rent in Dubai. The gross rental yields for apartments typically range from 5 to 7% here, but then once you subtract service charges, maintenance, and vacancy losses, your net yield is often just 4 to 6%. Here's a simple example. Let's take a one-bedroom apartment in GVC. Priced at $270,000. You could rent it out for around $19,000 per year. That's a 7% gross yield, which is fine. And let's say it's 800 square feet, and you're paying $5 per square foot in service charges. That's $3,300 annually, straight off your rental income. So your actual net yield becomes 5.8%. That's not bad, but nothing close to 8 to 10% guaranteed yields that are promised. So the developer would have to rent out your unit at a higher than market rates because they still have to take a cut. So the real return needs to be 10 to 12% or more, which isn't realistic in the current market. So there is one more thing they have left. Overprice the unit. Many guaranteed returns units are sold at up to 20% more than similar options, and then the developer pays that money back to you as your guaranteed returns. Speaking of being overpriced, that's the red flag number 6. Overpriced project. Everyone has a completely different idea of what overpriced means. Those who missed a good opportunity a year ago think that everything is overpriced now. So let's define the term. A project or unit can be considered overpriced if another one by a similar class developer in a similar location and of a similar type, meaning similar size, views and layouts, that's available now or was recently available, is priced cheaper. And don't forget the payment plan, it also should be considered. This approach is a bit impractical though. Finding perfectly comparable units without this criteria is challenging. So let's make a tweak to make the analysis easier and the red flag more evident. The question we ask ourselves is there a better investment for the same money? Let me show you how to apply it to the example of the Dubai Islands. All projects and numbers I'll mention are real. This is Island A. There is project right here that's nothing special. We'll call it Project 1. The amenities are standard, and it's a 20-minute walk from the beach. It sells one-bedroom apartments with no views for $530,000. That's $814 per square foot. But for $580,000, you can buy one bedroom in another project. Project 2 is closer to the beach. The apartments are larger, and the quality of the materials is better too. And even though it's more expensive, The price per square foot is just $531. So this tells us that the first project is definitely overpriced. Project 3 costs $626 per square foot, but it's actually worse quality than Project 2, so that's not worth it too. But then there is Project 4, which is just $495 per square foot, so that could mean that Project 2 is actually overpriced. The location of the fourth one is further from the beach, the developer isn't the same level, and the amenities are basic. Project 4 is not unique, and that's a red flag by itself. Red flag number 7. Low level of uniqueness. Imagine you're considering an apartment in a brand new tower in Business Bay. The spot is decent, the area is good, and the developer has a solid reputation. But then you realize that this single tower has 1,000 apartments. Once the project is completed, and all of those investors put their units on the market, your studio is just one in a sea of 1,000 others. That leaves you with no leverage when it comes to renting or selling, so maybe a smaller project seems like a smarter choice. For example, a mid-rise with 10 floors and about 23 apartments per level. That's only 230 units total, much fewer than the first project. But unfortunately, this won't solve your problem, because this mid-rise is part of a community of 70 almost identical buildings, all built by the same developer. And when the initial clusters are delivered, around 50 of those towers will hit the market at the same time. That's 11,000 units, all competing directly with yours. And this actually happened. Here's the actual price per square foot data from the second project I just mentioned. Even 5 years after launch, prices per square foot barely moved from where they started. If your property is just like thousands of others, don't expect strong appreciation. Also, don't expect strong appreciation if you spot the red flag number 8, hotel room. I don't want to generalize, but in my opinion, hotel rooms aren't usually the best investments. Let's break down why. First, you don't really have free use of the property. Once you buy the room, it's not like you can stay there whenever you want. The hotel controls that, and they might only allow you to stay for around 14 days per year. Second, you lose control over almost everything. The management company decides who rents the room, how much they pay, and even which units they promote more heavily. Third, the way income is shared can really hurt returns. Sometimes hotel pools rental income and splits it evenly between the owners. So even if your unit performs well, you might earn less because weaker performing rooms drag down your share. Fourth is hidden fees. Management fees, service charges, cleaning, and maintenance all add up fast. Even with good occupancy, these fees take up a lot of your profits, and since you can't switch the management company, you're stuck. Finally, resale is tough. Investors are aware of those problems, which means fewer people want hotel rooms. But don't confuse hotel rooms with apartments in hotel-branded buildings. Those are different. Branded residences can actually be great investments, especially if they're truly managed by a prominent hotel chain. The quality is often higher, and the name alone helps with the resale value. Many people are investing in hotel rooms because they want a high-yield rental property, and rental property investors should be aware of the red flag number 9. Low rent-to-price ratio. Rent-to-price ratio of an area is basically what it sounds like. You get it by taking an average rental rate and dividing it by the average price of the property. It's not a net yield, because it doesn't take into account operating expenses. It can be called a gross yield, so this is something you look at to quickly assess if the rental property is worth it. And to buy the average ratio is around 5%. But a good one starts at 7% or higher. So, if the potential rent-to-price ratio doesn't reach at least 7%, you need to question why you're investing in that property in the first place. Let's look at a real case. In one Dubai area, the average rent is $55,000 for apartments. This is based on real transaction rates, not the listing prices. At the same time, the average apartment price is 1.2 million US dollars. This gives us a 4.5% rent-to-price ratio, which looks like a red flag. We go check different apartment sizes in this area, but the ratio stays low. You could argue that the area will develop. There'll be so much more demand, and rental prices will go up. I believe you still shouldn't go for it. First, rental prices will go up that much only if the changes were huge, like transforming an industrial area into a family-friendly community with parks, schools, and a shopping mall. Second, purely mathematically. For one beds in this area, the rental rate needs to increase to 84,000 US dollars per year to get a 7% rent-to-price ratio, compared to other areas to see if it's reasonable. Third, even if you believe the changes will make the area very attractive, and the rental prices will indeed double, why take such a high risk? Usually, rental property investing is done to secure a stable cash flow, so if you can get a higher yield now, I think you should do it. And if you want help with this and any other requests related to Dubai real estate, we'll be happy to guide you through the whole process. Drop us a message, And check out the video made on areas that are about to experience massive growth. It's right here.